Okay, so just a quick recap. We didn't place any trades today, as I suspected. I thought today was going to be another horrendous day, and it was. Um, this is just. Let me just go back a little here. What time is it? Let's see if I can. Sorry, I'm just. Oh, it's no good. I'll do it like this. So yesterday we closed at down here, and once the cash opened, it basically would have just gapped up. That's not really a trade there. You would have just found the cash there, and then had to decide: are we going to buy it here? Because you ain't selling it there, that's for sure. And if you had decided to buy it, which of course I didn't, because I know just instinctively I knew it was going to happen. I just watched it and it just fell off again and turned around and came back up. So as you can see, it's so volatile just on the open from 9:30 US time to 10 that you always have these like really big moves. And these moves aren't really big enough to make decent kind of money. This one here was like around half a point, which would have actually been able to make money, but we weren't really in that in that frame of mind where we're trying to take half a point, because you're not going to get half a point. You're not going to get it right on the bottom. You're going to get it here like at 17.2, and then as it comes up, you're not going to get it at 16.2. You're going to sell it something down there at like 17.4. Plus you have to take 0.1 into consideration. So 17.2 to 17.4 is 0.2, and then there's 0.1 in commission that you're paying back. Of course we get some of that back, but in a sense we would have made 0.1. We'd have made one tick on that. It's not really a trade, and this of course is not a trade at all. There's nothing in that. Like, you're not going to nail this at that 7.04, so 17.1, 17.30. They would have had to have complete precision to make 0.1 after you'd paid your commission, and that's not a trade. That you would have not even broken even. So there's just been no opportunities. But like I said, we wanted to see the VIX drop off. And thankfully at the end of the day it sort of dropped again. The contracts rolling over. The March contract is expiring, which means that we can now get on and trade tomorrow, because we may have been able to make a little money today if we had, if I'd really worked this like a son of a bitch. Wouldn't have been easy, and I wouldn't have made a lot. But with the Fed stuff coming up, that's all Bloomberg's talking about, getting us ready for a June rate increase, not a cut. Sorry about that. Basically, no one's really trading, or people are trading, but they're just gently buying it. And you'll see some interesting stuff if I look at the S&P. So S&P had a big gap down on the open. It's opposite to the volatility, as you could see. You could see everyone selling into the open here and then covering their positions at the close of the day. So these people got short, and I guess probably hoping for a breakdown or something, but that didn't happen, so everyone just settled at the end of the day. There would have been obviously virtually an equal number of buyers that wanted to fill this gap. So whenever there's a big gap, the algos are always going to want to fill the gap. It's a standard play. So the algos start buying it here, hoping they'll get back here, and it didn't even do that. It was so lackluster, it was unbelievable. So if we look what happened on the open, we opened, where's it opened? Around 17.11, and we traded between 17.11 to 1705 and we closed at 1715. I mean, it's like a very, very tight range, no breakout, just stuck. And this is really indicative of some really big upcoming news. And oh bollocks. And if we look at the news that's coming up tomorrow, this is the Forex Factory. It's like a Forex thing, but I use it because it lists all the upcoming events. Very, very important, because that's when you get a lot of the volatility. And you can see from this is an hour after the open tomorrow, because we're an hour ahead on daylight saving, but that'll be evened up at the end of the week, because for some reason the US changes an hour early compared to Europe, which is pretty cool for me. I wish it was always like this, because it lets me finish an hour earlier. But over here we can see there's all this there's crude oil, there's all this FOMC, which is the Fed stuff, and it's going to be a really kind of crazy day. And even an hour before the open here, we can see there's building permits, which is really indicative of what the economy's doing. Not really, because it's all bullshit anyway, they bend the numbers, but it does cause volatility in the market, and the CPI. So tomorrow is a huge news day, massive. Let's have a look at the end of the week. There's unemployment tomorrow as well, and then the fully fed manufacturing index. Again, this is a lot of the industrial stuff, and it gives an indication of which way the economy is going on the industrial side, because if people are not spending money on industrial goods, like investing in machinery and stuff, it's seen as usually quite a negative signal for the economy. So there's going to be some massive volatility tomorrow, and on Thursday, yay, finally, because the last 2 days, I can't even remember shitty days like this. So no trades at all, didn't even bother. I was like hardly interested, because I knew this was just like this is just a way to get caught underwater as you try and buy this and then be unhappy. So I know it. What did I want to show you here? Let's have a look. So I wanted to show you a time where we would hedge. Now we only would really hedge when we are selling volatility. When we're buying volatility, there's not really a need to hedge, because if it does run through your order and you to go underwater, you know it's going to come back, especially if you buy it well. And a time when we would hedge is when we got it wrong on the sell. So let me just see if I can zoom in a little bit here. Give you a little example. This is obviously not going to be this is just a made up thing, because I haven't had to hedge. But so a hedge, we would think that the market was, this is well out. Hedge we'd be thinking that the market was going down, but actually what it did was it just turned around and went back up again. So over here, I'll give you a more recent example. Yeah. So let's see if I can make that a bit better. Okay, so here, where was it? February. Yeah, right. So the system's nearly fully automated now anyway. The hard thing is just trying to tell the system where the ranges are, because we don't just buy at 14 or 15, 16 and sell at 25. It depends on where the ranges are being established over a short amount of time. So this would be a really nice range to trade, because like 1 point, 1 point, 1 point, 1 point, like it's really obvious. We wouldn't have been selling it here. We'd have just bought it, waited, bought it, waited, bought it, waited, bought it, waited, and so on, until it got to about here, and then we would have sold it. because that becomes quite a clear place. But I want to show you a place where we would have had to hedge. So what we do is when we buy volatility, we just buy it. We place depending on where it is in relation to the bottom, and this is very, very close to the bottom, but depends on the size of our trade. So it's a money management thing. Now when we sell volatility, we have to have a hedge in place, because volatility has unlimited upside. So say we wanted to sell volatility here, we'd have a hedge. Wait, what number is that? 19. We'd have a hedge around 21. So we sell volatility, and it goes against us, and it hits our hedge. Now our position is delta neutral. So we've locked in a loss. Say we're like $2,000 down. Now we're going to remain $2,000 down as it comes up here. Now one position is going to be $4,000 up, for example, and the other is going to be $6,000 down. Once it gets here, we'll start to break the hedge and lift one of the legs, and we would then lift some of the leg so that the buy side of things has been is lighter than the sell side. So we're now going to start pocketing some of the profit. This isn't a profit game, by the way. We'll start pocketing some of that profit and start to remove it bit by bit by bit. So now, by the time it gets back here, we probably only have one side of the leg back on. In effect, we still be $2,000 down, but our balance will be $4,000 higher. But we still be running a negative position. And then we'll let it go through. That's a really oversimplified version of how hedging works. It doesn't really play out that as straightforward as that, because as I said, there is a cost attached. There's higher transactional fees. When you lift legs, often you lift a leg. Say we started lifting a leg early, we might have to put the leg back on. It gets, as I said, really, really complicated, and it's something which we try hard not to do, because what happens is you don't lose money, but you end up focusing a lot on trying to unwind hedges, and you have to unwind them very, very slowly, because as soon as you take off big pieces in one go, you inevitably will have to be putting them back on, because you don't want it to continue up. So that's fundamentally how we handle trades that don't work. This, you would have seen the market turning. Okay, maybe it's turning. This is around the level which is turned. No, it didn't. Got caught in a hedge. Picked up a hedge here. Lift the leg. Oversimplified. And then let it run down. And if it had turned here, we'd have had to put it back on again. Often make money from hedging, just because you're picking it up, it's running back down, you're taking some money, then you take that money, you take it down, then you reduce your risk on the other side. So say we made $4,000 there, but we're $6,000 down, we could basically make that position a lot smaller, and then we would still be $2,000 down, but our actual risk would be much smaller, because the contract numbers would be much lower, if that makes sense. So the position would be much, much, much smaller. So if there is a big rip, it's not going to be hurtful. There's many ways of doing it. That's kind of my way of doing it. Anyway, like I said, we fully automated. The problem teaching the computer or the algorithm and trying to train it is to train it where the ranges are. As I said, this is obvious as a human being, because you're buying, selling, wait, buy, sell, wait, buy, sell, wait. This is also a range which we were trading. Was it we were trading for you here? Don't think so. But this is a range which we were trading. This is a range I think we traded a little bit, but you don't make as much money. This is where you make lots of money. I think I said yesterday, these big one-way moves down or up, and this is like not even a range. This is just like this needs some Viagra or something, because just like nothing's happening. Anyway, so this one's a little easier, because we kind of knew it was at the bottom anyway, because of where it had been and what the broader markets were doing. Over here, you can see I'm a little bit more cautious because I know that it's highly likely to come down a little bit further, because that's kind of that's kind of what it does, and I want to get a good position over here. We would have handled that in a different way and been a lot smaller, but I'm looking to really try and capitalize on this and do well for us here. So we'll have to see. As I said, tomorrow it's very likely that we'll start trading again, pretty much regardless of what this does. I'm not going to be waiting around too much longer, because if it just after the stuff in the morning, where are we? The US time, it's evening for you, but just after the stuff at 12:30 UK time, what's that, 8:30? Well, that'll cause some volatility, and almost certainly I'll be wanting to trade there, unless it's flat again. But this is going to cause some incredible volatility, and I'm going to eat that all up. Yummy. And then again on Thursday, we've got some unemployment stuff. Yep, Thursday we've got unemployment in the US, and that is wild. So yeah, Monday and Tuesday 0, but I'm pretty sure end of the week we'll be where we need to be at 5% at least. So that's the video. Not even that interesting, I'm afraid, because there's so little that's happened all day. It's just been just a 0 day. Nothing's gone on. But thanks for your patience. It will come good, and it's the right thing to do. I can't just start forcing on trades because I'm getting impatient or I feel under pressure. This is what we have to do. We just got to wait, be patient, and on average we'll make good money. Thanks a lot. Speak to you tomorrow.